Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Saturn Oil and Gas. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. If you're interested in scheduling a meeting with Saturn Oil and Gas, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Kevin Smith, Vice President Corporate Development of Saturn Oil and Gas, which trades on the OTCQX Best Market under the symbol OILSF and on the TSXV under the symbol SOIL. Welcome, Kevin.
Thanks, Bob, and thanks for all of you joining us here today. So we are based in Western Canada. We're a conventional oil and gas producer. So what you're seeing here is a typical installation where we bore a bit of a farmer's field and drill into light oil deposits. And basically what you're not seeing underground is the horizontal section goes for a mile or two. So we really try to limit our footprint here. All our production's in Western Canada, but it's all conventional. And what I mean by that, we're not oil sands producers. We try to minimize our footprint, and really we're focused on developing oil and gas here in Canada. We're delighted to have joined the OTCQX just late last year. We have a growing number of U.S. shareholders, and that certainly facilitates the trade there. So I'll look forward to walking you through and talking a little bit about 2023. So we'll talk about some forward-looking statements. It's going to be an exciting year here for Saturn, and really what we got is expecting some big growth in our light oil production coming up this year. So the bar chart on the right, as we say here in Canada, is a typical hockey stick growth curve where we really, even a couple years ago, starting in 2021, had just a couple hundred barrels a day of light oil production, and we've really focused on an aggressive drilling program to increase the production, as well as a few strategic acquisitions that's really ramped up our production. I'll walk you through our latest transaction we closed just 2 weeks ago. So for the balance of the second half of the year, we'll be looking to produce roughly 30,000 barrels of oil equivalent per day. We're quite weighted towards light oil. We have about 82% of our production is in oil and liquids, and the balance being natural gas. Really, it's the oil side that's exciting for us. That drives the cash flow. In Canadian dollars, we expect roughly $475 million of EBITDA. It's a big amount of cash flow for our company. We're talking Canadian dollars. That's matched to our market cap. We're about $300 to $350 million, depending on which day, of course. And of course, what we're looking for is converting that EBITDA into free cash flow, and that allows us to take down some of our debt that we've incurred in some of these acquisitions, and really we're trying to increase the value to the shareholder by maximizing free cash flow. So if you put that over our share price of the $1.84 thereabouts Canadian, we expect to have in free cash flow this year. We're trading at about a 70% free cash flow yield. We'll compare that to some of our peers, but that's one of the higher yields you'll see here in the oil patch in Canada. And we've amassed over 900 drilling locations, and so that's more than 15 years worth of drilling. So we think we've got a very sustainable production base. So the big acquisition, we just closed this 2 weeks ago on February 28th. We acquired a private company called Ridgeback Resources, and this company fit in very well with our operating profile, also focused on light oil and had very large reserves in place. So this increased our production corporately by about 140%. So it's a big jump up for us. And so we are buying about 17,000 BOE a day of production. That topped up our 12,500 BOE a day. So certainly a big acquisition for ourselves. The first part we loved about this acquisition certainly was the price. We bought it for roughly 1.7 times cash flow. So that's a great bargain. And I think across all the metrics, especially on the reserve side, we're buying the proved, developed, producing reserves. We had a third party evaluate it, Ryder Scott, who our consultants. They saw roughly 40 million barrels of reserves that are on production now. We're buying those for roughly $13 in the ground. In Q1, we're expecting a cash flow net back after royalties and after production costs of closer to $50. So we've got it over about a 4 times our cycle ratio on that for every dollar we put in. Roughly $4 comes out, so great economics. We paid just over $500 million Canadian for the acquisition. We financed that with $375 million of term debt from New York-based family office. It's probably a well-known billionaire that we keep his name out of our news releases, but a very supportive family office. This is 4 times on different transactions that they've supported us from a debt basis. And when you're buying an asset for less than 2 times cash flow, you have the ability to have the asset pay down that debt very quickly. We also did $125 million equity financing that we announced on January 20th and closed later that month. And so that was about oversubscribed by probably 2 times. The lead order was an institution called GMT Capital out of Atlanta. So one of our big U.S. shareholders, they put in roughly $60 million into the deal. Another one of our longer-term shareholders, Libra Advisors out of New York, they put up $30 million. So between the two of them, we had $90 million into that offering, tag on a couple other institutions, and the top 4 guys took 90% of the deal. So a great success, and we're very happy to have their support and buy-in on our strategic motions here going forward on this acquisition. So some big shareholders and big expectations. We did take a financial advisor, Canaccord Genuity, global boutique investment banking and advisory firm. They basically put together a valuation for us. So if you don't believe myself that it was a very inexpensive acquisition, they looked at it from versus precedent transactions here in the Canadian oil patch, and by every metric on the reserves basis, cash flow basis, net asset value basis, they saw this asset would likely trade in that $600 million to $1 billion valuation. So I think we did very well in that transaction. So currently we have about 138 million shares outstanding on a basic basis. Depending on the share price, there's certainly been quite a bit of volatility this week, but that puts us somewhere between $300 and $350 million Canadian market cap. We do have some acquisition debt on the balance sheet, and that's one of our big focuses right now. We're paying that down as quick as possible with the assets that we have now and the support of the high price of light oil, which is still in a great position for us oil producers. About 60% of our cash flow goes towards paying down debt. 40% gets directed to the drill bit and keeping our production level flat. So like I said, in Q4, we hit our guidance, which was 12,500 BOE a day. Congratulations to the technical team and hitting that production milestone. And of course, with this big Ridgeback acquisition, we'll be moving up to quite a different level of production, certainly. If we pay down all of the debt, we probably have it extinguished by the end of 2025. But really, we're looking at the end of this year, we'll probably have the net debt down to about $350 million. That's about 0.7 times our EBITDA for the year on a trailing basis. So 0.7 times is not too levered, and we'll probably look to reduce the debt down there, probably targeting about a 0.5 times leverage ratio. So we now have 3 main development areas in Western Canada between the provinces of Alberta and Saskatchewan. Up until 2 weeks ago, we were 100% based in Saskatchewan, but we've been looking at ways to enter the province of Alberta, which is one of the heart of the oil patch here in Canada. And this Cardium asset that we acquired through the Ridgeback transaction, I mean, it checked every box for what we were looking for. It was high working interest, it's light oil, It utilizes modern completion techniques, and it's a very active area for oil development here in Canada, and having a lot of competitors having great success in there. And our technical staff, as especially our head of geology, has made a career in here. And so we've been looking for ways to get into the Alberta Cardium area, and this was a great acquisition for ourselves. Of course, in southeast Saskatchewan, we had the Oxbow asset, and the Viewfield asset that we took on from Ridgeback fits in very nicely with our operating platform. So we're right across the fence line, and basically that was probably the impetus of the transaction, where their asset fit in very well with us, and there's a lot of synergies for that. So we're now focused on developing these three main assets to maintain our production level of north of 30,000 BOE a day. We've kind of switched gears from growth mode into harvest mode, and sustaining this production, I think, will be manageable. We have over now 900 drilling locations that are on the books, supplied by our third-party reserve evaluators that will keep us busy for well over 10 years. It's weeks like this that we're quite glad that we have a pretty intensive risk mitigation program with our hedging strategy. Every time we do a new acquisition, we layer on some hedges and make sure that those assets are able to pay down the acquisition debt we take on, and give us some visibility when we're forecasting our cash flows going forward. So coming into 2023, and I'm addressing the chart on the left-hand side of your screen, we already had just over 4,000 barrels a day that was hedged out coming into last year. We did a large acquisition mid-year. We called it the Viking acquisition, that bolstered our production in west central Saskatchewan. And when we made that acquisition, it was the height of the high summer oil prices we saw last year. We locked in just over 2,200 barrels a day. We're now enjoying a base WTI price of $91 US dollars. So certainly well in the money on that hedge. And as well, with the Ridgeback, already came in with some hedging. So the bulk of our hedging for now is about 12,200 barrels a day. That's 54% of our liquids production. About half of our liquids are now subject to the stability of our hedge prices, where the low side kicks in about just around $70. So we're long-term bulls on oil, and we think that it'll be bouncing back here and trading that sort of range we've seen for a while, between $70 and $100 US. Everyone can make their own decision on where they think oil is going, but we did take some of that volatility out of it with some hedging. So we're hedged out through 2027. Most of it, the hedges fall off after 2026, and the amount that we have hedged comes down, in lockstep as we pay down all the debt. Diving in a little bit here, why we like the Ridgeback acquisition so well. This is the southeast corner of the province of Saskatchewan. We butt up against our neighbors there in Manitoba, but the further you go east, you run out of oil reservoir. The further you go south, there's North Dakota right below us, and great oil reservoirs, but not a direction we wanted to go. We were looking to go west, and that brought us right up against all that pink land you probably see on your screen there. That's all the land we picked up on the Ridgeback acquisition. Fits in very nicely with what we're doing, and we can't wait to get after that in the second half of this year, developing the oil resources that we acquired there. We'll be pretty active on that land. I would like to point out one thing that's really exciting for us right now, and this is a development that started in Alberta, where operators are now drilling 8 horizontal wells out of a single wellbore. It's unstimulated, conventionally drilled. It keeps the cost down by not having hydraulic stimulation to these wells. And what they're finding out is that it really worked well in the Clearwater area in Western Alberta, and now certain operators are taking that production technique and developing it right across our fence line and on the neighboring sections. And so one of our competitors, Crescent Point Energy, just put out their presentation that their first couple of wells have come on with an IP of over 225 barrels a day. that's a fantastic result for a well of that depth and great economics. So that's something that's just opening up in our area and expanding a lot of the land we have to new reserves that are not even booked in our resources. So we will be drilling one or two of these 8-legged wells in the second half of this year. And so we've got some exciting results that we're looking forward to put out to our shareholders. Again, this is the heart of the oil patch in Alberta. This is the Cardium play. This is one of the crown jewels of why we bought the Ridgeback property 2 weeks ago. It's got just a tremendous amount of drilling in front of it. There's over 300 locations for new horizontal well development that we see will keep us busy for many, many years and developing light oil here and great economics. So we'll be also busy drilling this in the second half of this year as well. It's worth looking in kind of how accretive some of these acquisitions can be. Our last quarter that we put out financially was back for Q3 of last year in November. We put it out, and it shows really the impact of the Viking acquisition that we announced on May 31st last year, and it kicked into Q3. So we had a big jump in production, up 50%. Our operating netbacks, because the production we're buying is very low royalties and very low operating costs, where in Q2 we were netting back 30 Canadian dollars per BOE that we produced. That jumped up almost 70% in Q3. We were getting $50 Canadian. And so that really drove some big step up in our cash flow. We had a record of $18 million of cash flow in Q2. That jumped up over $50 million of EBITDA in Q3. And that's on 11,000 BOE a day. Q4, we've already announced to our shareholders, came in at 12,500 BOE a day. So that's record production for ourselves. And I think that's also going to drive record cash flow. And when we put it on a per share basis, we went from 45 cents in Q2 of cash flow per share, or adjusted funds flow per share. And then that jumped up to 69 cents. So Q4, I think we're going to say even higher yet. I think we'll be north of 80 cents. We'll be putting out our financials on about March 28th. So that's a key date for ourselves. We have a big quarter here and looking forward to sharing that with our shareholders. The drilling program last year was quite robust. We drilled 57 horizontal wells in Saskatchewan, all targeting light oil, and we had 100% success ratio. So that was quite a good accomplishment for our technical team and our geologists. Not everybody went 57 for 57 last year. And so they're all in production right now, producing light oil. We had particular success in our Viking property in West Central Saskatchewan. We're 38% above our type curve there. And on a kind of combined basis, we're 16% above our expectations or what we forecast for our guidance. So a great year of drilling. We've already done 13 wells here in the first quarter of this year. And those were all successful as well too. So I think we have some good results to put out to our shareholders. We typically report on an IP30 basis. After we get 30 days of production, that's typically what we put out. And these wells, we're expecting 70 barrels a day for the first 30 days. And so far, we've been quite above that. So hats off to the drilling team. I'll jump ahead here to our guidance. We did put out our guidance when we announced this transaction for the Ridgeback on January 20th. Oil was north of $80 US at that point in time, slipped below that, but I'll talk a little bit how our hedging softens that blow. Like I said, we'll for the calendar year, we'll be about 27,000 BOE a day. That's based on being over 30,000 for the second half of the year. And that's going to drive some robust cash flows. From the field level, we'll see over $500 million of EBITDA Canadian. We expect to lose $45 to $50 million on our hedge book, which is fine. If oil was at $80, leaving $475 million of EBITDA, that's going to amount to cash flow after interest of $393 million. That's roughly $3.20 per share. I think that our share price is a little bit below $2.50 now. Took a little hit with the rest of the market. So we're less than 1x cash flow on a trading multiple. So that's quite low compared to our peers. If you include in the debt, of course, which is reasonable, our enterprise value at year end is expected to be $700 million. And so that equates to about a 1.5 times. We're probably a little bit below that now to enterprise value to EBITDA. And I'll show you kind of where our peers trade. And so, and focus on that cash flow, $1.84 per share free cash flow. It's over about 70-75% free cash flow yield. So I think there's a lot of value that's backing our shares, certainly in the reserves and in the production and the cash flow. We are 54% hedged on our liquids to our hedge contracts that are in fixed WTI amounts. So really that kind of protects us from the downside. There's some sensitivity here. Roughly for every dollar change in WTI, our adjusted funds flow or cash flow will go up or down by $4 million. So not as quite as dramatic, I think, as most of our peers. And we do try to take some of that volatility out of our cash flow profile. I mean, even if if something bad happened and oil fell even like to $30, our hedge book becomes quite valuable. We may not make a lot of money in the field, and not a lot of oil producers would, but our hedge book would be worth roughly $200 million for calendar 2023. We'd still have $1.50 to $2 of cash flow per share just from our hedging, and that kind of helps us sleep well at night as oil prices jump around here. Last slide before we jump into questions. We do have 7 research analysts that cover us. There's 7 buy ratings. The average target price is about $6.50. So I think analysts are seeing about a double and a half from our share price. And then I did borrow this slide from Paradigm Capital, one of the research companies that does follow us. They have us on that left chart at roughly 1.4 times enterprise value to debt adjusted cash flow, or enterprise value to EBITDA, similar metric. And that basically puts us at the bottom end of valuation with our peers. We're set against some other Canadian listed Canadian oil developers. And so certainly I think that Saturn is one of the fastest growing oil companies here in Canada. And I think we're probably one of the most value priced. The two might be related as well. So I'm going to dive in here, and I can see it's starting some of these questions loading up here. So let me take some of this here. Okay, I do have a question here, just kind of going back and talking about some of these sensitivities. So for could you please provide your sensitivities for EBITDA for 2023 for a WTI price of 50 and 60? And so this will be available. Let me get to here. This is available. We'll be posting this midday here on our website, this updated March presentation. But like I said, for every dollar of WTI, we're gonna plus or minus $4 million. And so for every $10, you'll see plus or minus $40 million. So we'll probably see that 390 million drop down to somewhere 350 million if oil prices average around this $70 range, because we're about that right now. So still pretty robust cash flow. Certainly on a per share basis, I think would still be about less than 1 times cash flow, given where we're trading now. So yeah, I think that's one of the things that we do try to stabilize is how much volatility we're exposed to for oil prices, which seem to be moving around a little bit here. Another question here. Thoughts on your valuation and catalyst for re-rating Saturn? I think one of the reasons why we are so inexpensive, certainly I think it's the rapid growth we've had. I don't think we've been on the radar screens for serious investors until just really a year ago. We obviously have some large institutional backers now, and I think that's raising our profile. And another thing is eyes wide open with these low prices of oil assets here in Canada. And there's just been a lack of investment in the sector in general. And my background in finance, I've been following the industry for over 20 years, and we've never seen multiples this low. Buying solid, high quality assets that are cash flowing, and you're buying it for less than 2 times. It's a very low metric. So one of the things that we're doing right now is cleaning up the balance sheet. I think that as we keep paying down that debt, and as most of our shareholders are looking at for us to do that, we'll right size that balance sheet, and I think that's going to lead to a re-rating. Most of the research analysts have us at a target price of roughly 2.5 times to 3 times going forward. We're currently trading at 1.5 times, so I think there's a chance for a re-rating and a jump up in the stock just from catching up to our peers. Another question, and I'm glad this was brought up, is can we speak to the shareholder returns, buybacks, dividends, and given our strong cash flow? Yes, and that's exactly where we're going with this. We're not trying to be too forward leading in terms of where we're getting with the free cash flow. But once we pay down the debt, and by sometimes, by probably mid-year, I think we'll hit that 0.5 level of debt to our EBITDA. I think, we'll quite have delevered the balance sheet. And at that time, we can look to refinance and make the debt a permanent part of our capital structure. And so if the free cash flow is not going down towards paying debt, that'll be available for dividends, share buybacks, and maybe some increased CapEx in the future days. And so, we're paying down our debt roughly about $25 million principal payments Canadian every month. So it's not going to be there for very long, and certainly will be quite a bit less net debt by year end. And at that point in time, we'll be looking forward to, announcing a more sustainable, return of capital and cash flow to our shareholders. And certainly that usually leads to a big re-rating as well. Key milestones for 2023, after this Ridgeback acquisition. Certainly one of the big deals we have coming up is putting out our financials. I think we're sitting on a very great quarter for Q4. A little bit looking back, but we've always had a great response from the market. No we've ever, hit our milestones, and you can see the robust cash flow per share. So the proof is always in the pudding. So we look forward to putting that out as well. We did put out just 2 days ago our reserve evaluations. It's our year-end report card where Ryder Scott looks at our reserves, and we had a great win there. We had our total reserves went up 24% year over year, so we've had some great growth there, as well as our net asset value on approved developed producing basis went to $6.90. So another indication of the value backing the Saturn shares. And then from there, we're just going to have a great amount of drill results. Last year, we drilled 57 wells. That was a record for the company. We're almost doubling our CapEx budget for this year. So we'll have plenty of drill results and keep hitting our growth targets. We see them going quarter over quarter and really just delivering on our game plan. Another question, is Saturn traded on any other exchanges? And yes, we are. We did add the listing just last year for our U.S. shareholders, and that's a growing group, especially on the institutional side. We do have the TSX Venture, that's our home listing here in Canada. We'll probably be upgrading to the TSX, the main board, pretty soon to match our growth profile. We've a bit outgrown the venture. It's been fantastic for us over the last several years, but it's time to graduate, and that puts us also with a higher market cap class of companies, and certainly opens us up to some other institutional investors that only focus on the main board. We're also traded in Germany. We have quite a number of high net worth German investors that have been with us for many years as we've been building this oil and gas company. So we are listed on the Frankfurt, the Stuttgart exchange. We trade in euros there, and so we try to make liquidity as easy as possible for our shareholders. A reminder for the ticker symbol in the U.S. it is OILSF, and then in Canada we're SOIL, SOIL for Saturn Oil. Looking for any questions here? Well, I think that's all the questions, so better wrap it up. And thanks for joining us. And yeah, if you're looking for putting some oil and gas into your portfolio, I think you should consider Canada. Pretty high standard for environmental protection, and also consider Saturn. I think we've got a big year ahead of us in terms of developing light oil. Thanks for joining.